And we're back. Stabilis Netflix episode 3. Us distressed guys find it hard to be optimistic. However, given the current economic environment, we think the glass may not be half empty. Why is that? Well, if we look at issuance in the commercial real estate space, which is the largest market that we look at, it has been very, very high. CRE CLOs are back. They were called CDOs before, but now they're called CLOs. They're the same thing. Issuance this year in the first half is greater than it was all year last year. Issuance is also higher because of that in the overall capital markets, and we expect this trend to continue. And all this is happening at historically low spreads. God bless America. The debt markets do not think there is a problem. On the positives, the US is growing at 4.1% growth rate, which is a great growth rate any way you slice it. It is broad-based growth. You've seen consumer spending now being higher, both in general consumer spending and in discretionary income. One of the measures of discretionary income is same-store sales at restaurants, and we've seen those increase, which is reversing a 16 and 17 lackluster trend. So consumer high confidence is now translating into high consumer growth. Corporate sectors, which saw a double-digit growth rate increase because in the wake of the Tax Act, is now actually continuing to grow, albeit at a slower rate, which we expected in our last letter. But it's a good growth rate of six and change, which is still which is translating into a high growth rate in the overall U.S. economy, coming from both the consumer and the corporate sector. More broader capital markets are actually seeing several indicators of volatility. The biggest indicator of this was drops in Facebook and Twitter in one day. The Facebook drop of over 20% in one day was the highest of a public company's loss of market cap of over $120 billion. So now we've figured out what happens when all the momentum and algorithm traders, and most of them are computers, point to the same signal, sell, and there's no human left inside. In terms of the 2-10 spread on the treasury market, which is another indicator of risk, we are seeing that trend to zero. So it's at 23 basis points, which is one of the lowest rates today. Now we'll get into some arcana. Other measures of risk are skew, which is the risk to the downside versus the risk to the upside. And that is actually at high levels as well. So market is perceiving, while generally robust growth environment today, is perceiving risks to the downside that are significant. So let's take a look at the international market and see where some of this risk is coming from, because we don't perceive it in the US markets. In the international markets, you see slowing growth in China and India. You see stalling growth in the European Union and the Eurozone in general. And you see implosion in Turkey. So the question is, there are risks to the downside that are significant, and what happens if some of the things that are causing some of these implosions actually translate into some of the bigger markets? So a US-China or US-India trade war or US-Eurozone trade war are not a zero probability event anymore, and they can have significant downside downdrafts in the economy. We are taking advantage of robust capital markets in general by accelerating resolutions at good levels. The biggest indicator of that is we refinanced one of our loans in Puerto Rico at par into the banking market. Last year, that loan was something where we were the only provider of funding, and today it's in the general capital markets. Overall, we're seeing robust originations. We're seeing an opportunity set to put capital to work. We're doing it at very, very attractive LTVs. Today, our LTV is for the 42 million in origination, so robust Q2 origination level. Our LTV overall was 34%, which is very conservative and downside protected.